In this topic we're looking at monetary policy, and what monetary policy is one of the major policies available to either stimulate economic activity if the economy is in a bit of a downturn or a recession, or slow the rate of economic activity down if inflationary pressures are an issue. The other policy that can be used to do that is fiscal policy, but we'll be looking at that a little bit later. So for now we're looking at monetary policy, and this is what we're going through. So we're going to be looking at monetary policy in Australia and how it differs from monetary policy in Singapore and Hong Kong in terms of the operation of monetary policy. Then we're looking at how the money supply can be increased or decreased, and when the money supply changes, what impact does that have on the price level? We'll be looking at that, and then to finish this particular topic, we'll be looking at unconventional monetary policy and the three major unconventional monetary policies that are used by central banks. Okay, so first of all, we need a bit of a definition of monetary policy, and the definition is the use of either the money supply, interest rates, and that can be short or long-term interest rates, or the exchange rate to influence either the inflation rate or the rate of economic growth. So monetary policy is implemented by central banks. In Australia, the name of our central bank is the Reserve Bank of Australia, or the RBA. Now right down the bottom here I've got a web link which takes you to a page which explains in great detail how monetary policy in Australia actually operates. So you having an excellent understanding of how monetary policy in this country operates is very, very important. You also need to have a reasonable idea of how monetary policy in Singapore and Hong Kong operate as well, so that you can contrast the way monetary policy operates in Singapore and Hong Kong with the way it operates in Australia. So make sure you go to that link and have a good read through all of the information on monetary policy in Australia. So just a bit of a preview though before you go away and start reading up on monetary policy in Australia and monetary policy in Singapore and monetary policy in Hong Kong. I want to give you a bit of an overview, but before I do that, monetary policy in Hong Kong, we won't be doing too much work on that in this topic because monetary policy in Hong Kong involves keeping the Hong Kong dollar fixed against the US dollar. So we're going to leave our discussion of monetary policy in Hong Kong until we get to the exchange rate topic in a couple of weeks' time. So, but just briefly, I want to run through and emphasize that monetary policy can take many different forms. Ultimately, most monetary policies target, or the ultimate target of most monetary policies is to keep inflation low. And central banks around the world believe that if they can keep inflation low, they will create the right economic environment that encourages savings and investment in capital equipment and investment in R&D, which leads to long-term growth. So the whole idea of monetary policy in Australia targeting a 2 to 3% inflation rate is to create the right macroeconomic conditions for long-term growth through savings, investment, capital accumulation, research and development, all of those sorts of things. So in terms of how monetary policy differs among these three countries, in Australia it's all about changing interest rates to try to affect the overall level of aggregate demand to ultimately target the inflation rate. And we know why now a low inflation rate is desirable, because it creates that optimal macroeconomic environment for long-term growth. However, monetary policy in Singapore is completely different. The ultimate objective of monetary policy in Singapore is to target a low inflation rate to maximize long-term growth, but the way they do it is very different. In Singapore, they use interest rates and foreign exchange market intervention, that is buying and selling foreign currency, and it's the central bank that does this, to keep the exchange rate within an upper and lower band. So I do have, on the LMS page, I have a link to a paper which is published by the Monetary Authority of Singapore, which goes through monetary policy in Singapore in detail. But just for now, I want you to appreciate that monetary policy is not all about moving interest rates up and down to control spending. That's just the way we do it in Australia. And certainly it's the most common way it's done around the world. But when you have a small open economy such as Singapore, the way we operate monetary policy in Australia is just simply not going to be effective for Singapore. So they have to keep the value of the Singapore dollar or the Singapore exchange rate between an upper and lower band. They can't allow their exchange rate to rise too high. If they do that, import prices, and imports are a very important part of the Singaporean economy, if the exchange rate rises above the upper bound of this band, then import prices will fall and there will be deflationary pressures on the economy, and we know the dangers of deflation. If they allow the Singapore dollar to drop below the lower band, import prices will increase and that could lead to inflationary pressure. And then finally, monetary policy in Hong Kong is all about keeping the Hong Kong dollar fixed. And when we get to the exchange rate topic, you'll see how interest rates and effectively the money supply in Hong Kong need to be manipulated to keep the exchange rate fixed against the US dollar. So certainly with a fixed exchange rate, you do lose a little bit of flexibility in terms of the use of monetary policy, because that monetary policy needs to target the fixed exchange rate and it's not necessarily free to keep inflation low. Okay, so in terms of the way monetary policy operates in Australia, certainly the link that I gave you a couple of minutes ago to the RBA website will provide you with a lot of information, but a little bit of a review. You need to have a broad understanding of the operation of the overnight cash market. Now we know that in that overnight cash market, major financial institutions lend money to each other, and the interest rate payable on that lending is the cash rate, and the cash rate is the interest rate that the Reserve Bank controls. Now the lending between banks is mainly mainly occurs to settle interbank payment obligations. So if one bank needs to send another bank money at the end of the day and it doesn't have enough money in its exchange settlement account, then it needs to borrow money from somewhere else in the market so that it can make that transfer to the other bank, and the cash rate will be paid on that loan. So when the cash rate changes, if we just skip ahead, we know that when the cash rate changes, the 30, 90 and 180 day bank bill interest rates change almost one for one. I know that in terms of this graph it's not exactly one for one, but it's close enough for monetary policy to be very effective in this way. So remember, the 30, 90 and 180 day bank bill interest rates or yields represent the costs to the bank of borrowing money to finance all of the lending that they want to do, so to borrow that money in financial markets. So this is the short-term debt markets that we're talking about here. So when the cash rate changes, it has a very powerful influence over the interest rate that banks pay on the bank bills that they issue to borrow money for short periods of time. And of course, in the other diagram here, we've got the cash rate. Unlike long-term interest rates, the cash rates, or the short-term interest rates, the policy interest rates they're sometimes called, are not highly correlated across countries, because these interest rates are being moved up and down at the discretion of the central bank in each of these countries in response to domestic macroeconomic conditions. So obviously in 2005-2006, interest rates in Japan were flat at zero. This is the policy interest rate, Japan's version of the cash rate. So obviously Japan's macroeconomic situation was not good. However, in the United States, their federal funds rate in 2005-2006 was increasing from 1% up to 5.25%. So short-term interest rates at the control of central banks, and therefore they are not correlated across time like long-term interest rates are. So now that we know that a change in the cash rate affects short-term interest rates but not long-term interest rates, and the reason that changes in short-term interest rates don't affect long-term interest rates is because of the expectations hypothesis, and we covered that in the topic, the microeconomics of financial markets. So when short-term interest rates change, they don't affect long-term interest rates because long-term interest rates are more interested in the course of interest rate changes over the next, say, 10 years, if we're talking about 10-year interest rates. So we know a change in the cash rate affects bank bill rates. They almost move one for one. And then a change in bank bill rates changes the weighted average cost of bank loan book funding. That'll become, what I mean by that is, will become clearer in a little while, but then when the weighted average cost of bank loan book funding, which is basically the weighted average cost to the banks of borrowing money to finance their lending, when that changes, they generally pass those higher costs, or the change in costs onto their customers. So in this example, right at the bottom here, I've got banks pass on these higher costs to customers. I'm assuming that the change in cash rate was upwards. Okay, so one of the issues here is when the cash rate changes, bank bill interest rates change, but bank bills are only one source of funding that the banks use. They also use customer deposits, short-term debt. Well, actually, sorry, let me start that again. When there is a change in the cash rate, bank bill interest rates change. And bank bill interest rates are the interest rates on short-term debt, number 2. Banks also use 4 other sources of funding: customer deposits, long-term debt, equity and securitization, with the last 2, equity and securitization, not being major sources of bank funding in Australia at least. So the situation, the issue is this: if the cash rate changes, for the bank to be able to pass on, and let's consider a cut in the cash rate now. Let's consider a 0.5% cut in the cash rate. For the banks to pass on a 0.5% cut in, say, mortgage interest rates, then when the cash rate falls by 0.5%, the banks need bank bill interest rates to fall by 0.5%, which generally happens automatically. But also, they need to cut customer deposit rates by 0.5%, and they need long-term debt interest rates to be cut by 0.5% as well. And what we've learnt in this course is that the interest rates on 1, 2 and 3 here are driven by different forces. So it could be the situation, and this has happened in the past, just after the GFC in fact, the cash rate could be cut by 0.5%, which will reduce interest rates on short-term debt, but at the same time you could be in a situation where global forces, that is international capital mobility, global interest rates, could be pushing interest rates on long-term debt up. So the cash rate's coming down by 0.5%, but the interest rates on long-term debt are rising. And so the higher interest rates on long-term debt, in terms of the bank's average cost of funding, could actually neutralise the reduction in the cash rate, or at least partly offset it. And there have been instances of that just after the global financial crisis in 2009, where Australian banks were watching the cash rate fall, but at the same time, so bank bill interest rates were falling, interest rates on short-term debt were falling, that is, but interest rates on long-term debt were rising. So the banks weren't able to pass on the full interest rate cut. So that's a complication of modern monetary policy. What I've got in this graph is the change in the funding composition of Australian banks. So you certainly need to know how a change in the cash rate flows through and affects mortgage interest rates, and the complexity that I've just gone through. You also need to know how when mortgage interest rates change, and also all retail interest rates, so small business interest rates, car loan interest rates, you need to know how changes in those types of interest rates, which I call retail interest rates, affect aggregate demand, how they affect the aggregate demand curve in the ADAS model, so you need to be able to illustrate that using the model, and how then changes in aggregate demand affect real GDP and the inflation rate. So coming back to this, we've got this graph here which shows the funding composition of Australian banks from about 2004 through to 2014. So the interesting point here is around about 2008-2009, following the global financial crisis, you can see that there were some deliberate and quite significant changes to the funding composition of banks in Australia. That is, there was a change of the sources that the banks used to obtain their funding. Banks moved away from short-term debt in 2008. They moved towards long-term debt, and they moved towards domestic deposits. Now, what you would have seen in this course, if you understand a yield curve, and you understand that annual interest rates on long-term borrowing are generally higher than interest rates on shorter-term borrowing, then, and that's the same as saying the yield curve is upward sloping, then you know that annual interest rates on long-term debt are higher than the annual interest rate on short-term debt. And we went through that in topic 6, the microeconomics of financial markets. Now, if that's the case, then this move by Australian banks away from short-term debt and towards long-term debt is quite interesting. It's definitely a more secure thing to do. In terms of the long-term viability of the company, in terms of the risk management of the company, moving towards long-term debt is a sensible thing to do just after a financial crisis. However, the fact is, they were moving away from short-term debt in 08-09, which has a low annual interest rate, and towards long-term debt, which has a higher annual interest rate. So that change in the composition of funding would have actually increased the weighted average cost of bank funding for the banks, and it would have made it more difficult to actually pass on all of these interest rate cuts that were hitting the Australian economy in 2008-2009. So the banks would have had to have held back some of the cuts in the cash rate simply to compensate them for the fact that they were moving away from cheap short-term debt to more expensive long-term debt. Now, in terms of why they actually changed the funding composition towards long-term debt and towards domestic deposits, it was simply risk management. The problem that the banks faced leading to the global financial crisis of 2008 was they had 35% of their funding financed using short-term debt. And that short-term debt is cheap, much cheaper than long-term debt, so it's a more profitable way for them to operate in times of very sound macroeconomic conditions, both domestically and globally. However, the problem with short-term debt is it rolls over every 30, 90, 180 days, depending upon what type of debt the bank has issued. And so if you've got hundreds of millions of dollars, if not more, of short-term debt, say billions of dollars of short-term debt, and that debt is rolling over every 90 days, it is cheap, but the fact that you have to roll it over and reissue that debt once the 90-day period is over means that you're very exposed to financial crises. And that was happening with the Australian banks in 2008-2009. They got into a situation where the financial crisis hit and they had to roll over their short-term debt. And they weren't able to reissue that debt at anywhere near interest rates that they were paying previously. The interest rates were so high that the banks were having trouble making money on the money that they were borrowing through the short-term debt market. So they were rolling over short-term debt at, say, 5%, so maybe a series of 90-day bank bills had expired. They borrowed that money at, say, 5%. Then the GFC hit, and they were being asked to pay 8 or 9% on that money. So when interest rates do jump on short-term debt and you are rolling that short-term debt over, you get exposed to those higher interest rates almost immediately. That's not the case with long-term debt. Long-term debt by banks in Australia, the most common period of borrowing is 5 or 7 years. So if you have bonds on issue for, say, 7 years and a financial crisis hits, it's not as much of a concern because you've got that money locked in for 7 years. You can ride out the storm. You don't have to roll those bonds over. So it's just safer. Domestic deposits, similar argument to bonds. During a financial crisis, people tend to save more and leave that money in the bank in either their savings account or a term deposit. So Australian banks moved towards domestic deposits because it was seen as a very safe and stable source of bank funding. Certainly more stable than and safe than short-term debt. Okay, and then in terms of the monetary policy transmission mechanism, I'll let you do reading about this transmission mechanism yourself using the monetary policy information from the Reserve Bank's website that I'll provide a link to. But basically, when the official cash rate changes, that then has a lot of effects. First, so let's consider a cut in the cash rate. That will reduce market interest rates, and ultimately that will reduce retail interest rates. It will also boost asset prices. So as soon as the cash rate falls, you'll tend to get a bit of a pickup in housing prices, a pickup in stock prices. That creates a wealth effect where people get more confident, they feel wealthier, they spend more. A cut in the cash rate also improves expectations of the future and business confidence in general, and change in the cash rate reduces the exchange rate. Now all four of those things either increase domestic demand or increase the demand for Australia's exports. And in particular, the reduction in Australia's exchange rate, that has the biggest impact on net external demand. But net external demand also means not just exports, but it also means imports. So if the cash rate falls and the exchange rate goes down, net external demand means that the economy will be stimulated by not only a pickup in exports, but also a reduction in imports because the exchange rate's higher. And if imports are falling, it means that very often that money, that spending, will be diverted from imported goods to domestic goods. So that kind of helps boost net external demand as well. Both domestic demand and external demand feed into total demand, and changes in total demand, which is just aggregate demand, affect domestic inflationary pressures. The exchange rate, so if we lower the cash rate, the exchange rate falls, that will also feed through to an increase in import prices, and that'll affect inflation too. So this diagram here, this is the full monetary policy transmission mechanism, and you need to understand that and be able to talk about it. What we did in terms of this work, that is understanding how change in the cash rate affects retail interest rates, that is one of the main parts of monetary policy, but it's really just how the change in the official rate on the left-hand side affects market interest rates. Okay, there's obviously a lot more to the power of monetary policy, and it really comes out in this diagram. Okay, so I'll leave this particular presentation there, and what we're going to do next is look at how the money supply can change and how changes in the money supply can affect the price level.